Good morning, everyone. My name is Sarah Darling, and I'm a volunteer with the Community at Home virtual workshop series. It's my pleasure today to introduce David Malaga, who will discuss retirement planning and transferring wealth to the next generation today. So David leads the Malaga Group at BMO Private Wealth in Burlington, Ontario, which provides affluent families, business owners, and corporations with wealth management solutions. David has extensive experience across banking, compliance, institutional trading, product research, and institutional and private client wealth management. As a CMT, he follows a unique and highly technical investment approach, incorporating macroeconomic, fundamental, and technical analysis. So David understands the subtleties, complexities, and unique importance of managing wealth to last generations, and is your trusted go-to advocate for your family's questions and concerns, building and protecting your wealth with dedication, expertise, and care. So thank you, David, for coming. And at this point, we'll turn it over to you.
Very much. Good morning. I'm David Malaga, as you can see in the picture. I'm an investment advisor at BMO Nesbitt Burns here in Burlington, Ontario. I met Linda at Brantford Chambers of Commerce meeting, and she gave me this opportunity, and I'd like to say thank you for that. And I'd also like to say thank you for attending on this rainy day. Next slide. Perfect. The topic of our conversation today is retirement planning and transferring wealth to the next generation. Linda did mention that majority of the attendees are already retired. So we will focus majority of the conversation on the transferring of wealth. So our agenda today, brief introduction on myself and my team, what do we do and how we do it, the great wealth transfer that is taking place and going to continue for the next couple of years. Why is it important? Things to think about, the role of the executor, the powers of a power of attorney, what does a will do and what does it protect, strategies to distribute your wealth, trusts, retirement investment strategy, how to protect your wealth, documents you might need, and role of the advisor and the value add. Next page. So as Sarah mentioned, I've been doing this for 17 years. I've worked all over. I've worked in New York City. I've worked in British Columbia. I've been all over. So my goal is to help families, business owners, and corporations with wealth management solutions. I've done it all. I've done banking, compliance, institutional trading, product research, and institutional private client wealth management. Throughout my years, I've held a variety of prominent investment-focused roles, from working on trade desks in New York City to developing portfolio management programs for private institutional wealth management firms here in Canada. But my main role is here to work with retirees and pre-retirees due to the fact of the large population of baby boomers. Next page. Go back. Oh, one more. Yeah, there we go. So with my team and the offering from BMO Private Wealth, we have an internal private banker that I work with that can open up estate accounts, but review your credit cards, lending, pretty much any offering from the bank. We also have an internal tax planner that can focus on U.S. and Canadian taxes, but also trusts. And she wrote the book tax tip for Canadians. Tax tips for Canadians for dummies. And also we have an internal lawyer that strictly focuses on estate planning with complex situations. And then also we have an internal financial planner that builds out detailed financial plans where we can run multiple scenarios and to see, what's the best way to save taxes and fund your retirement, or make sure that the assets in your estate get passed on in a very tax efficient way. Next page. So what do we do? My value proposition to my clients and prospects is my goal is to reduce overall taxes, consistent tax efficient returns, competitive fee structure, protect and transferring your assets to your loved ones. So the services I provide for my clients are investments, tax planning, banking and borrowing, financial care and management, because retirement is just more than money, trust services, philanthropic services, succession planning for business owners, estate planning, and putting everything together as a wealth plan. Next page. So great wealth transfer. So in the next couple of years, on average in North America, there's almost going to be $1 trillion change from one demographic to another demographic. And as you can see the charts, this is based on the age of baby boomers, and we're currently in 2024, and this is going to accelerate to the years of 2041, where the baby boomers will be in their late stages of their life cycle. And this was based on a survey in Canada in 2012. So these assets are probably a little bit higher due to appreciation of assets in real estate. Next page. This is just a simple chart, and I wanted to identify like how big of this impact is going to be. The blue line, and this is just strictly based on US data, because for Canada it was a little bit harder to find, but there's around $160 trillion that are held through multiple households with different age groups. However, as you can see in the green line, the baby boomers are pretty much holding half of the assets that are in the economy. So it's around $80 trillion. So in the next couple of years, these assets are going to be distributed to the Gen X generation, the silent household, and also millennial. And I think this is going to have a big impact on younger generations because the cost of living has increased drastically, and the younger generation can benefit from some of the assets from the baby boomers. Next page. So there was a survey conducted by Environics back in 2019, and just based some statistics on how are people treating this wealth transfer. So the biggest intergenerational wealth transfer in Canada is taking place. Most Canadians are keeping their hearers in the dark on how they plan to pass on their wealth revealed in the poll. So survey results showed 58% have not discussed instructions for their estate with their hearers. And the hearers could be children, grandchildren, and other beneficiaries. 12% do not plan to talk about their inheritance plan at all with their beneficiaries. 32% say they're worried about how their heirs will handle their inheritance. 36% say their children don't have the financial literacy to manage a potential windfall. Also, data revealed that 1 in 5 say that they have introduced their children to their financial advisor or have taken them to a planning meeting to currently talk about their money. And these are some troubling statistics because you can see that there is a lack of planning, and usually when there is a lack of planning, stuff comes up and it usually becomes very costly and stressful. Next page. So intergenerational wealth transfer. Why is it important? So the goal of estate planning is to put in place a comprehensive plan to make you feel more secure about your future, the future of your loved ones, that they will be taken care of. So providing support and financial stability for your spouse and children, preserving assets for future generation, ensuring all your assets will be distributed according to your wishes, and that will be through a power of a will. Minimize taxes and expenses. You will pay taxes even after death. The government will not forget that. Ensuring that individuals you choose can make decisions on your behalf in the event of incapacity, and that's the power of a medical power of attorney. Supporting a favorite charity or wealthy causes. If you do not have children or grandchildren, there are great charities that you can donate and you can build a legacy from that. But also with BMO Private Wealth, we do due diligence on all these charities that make sure that these are great causes that are run efficiently and to their best manner. During death, there is probate. So also, the question is how to avoid probate, protect inheritance from creditors, and then also reducing disagreements among peers. Usually during a passing, family bonds and connections do get challenged, especially when assets, and the more money, the more problems that usually happen. So that's something to take into consideration. Next page. So things to think about. I know everyone has questions, but are you concerned about whether your heirs have the ability to manage or protect your wealth? Do you and your family members have special needs? This could be a child with a disability or one child having a bigger family than another. To whom do you want to leave your financial assets? This could be a classic car or a piece of jewelry or some specific asset that you want a specific person to have. Are there specific assets you like to give specific individuals? Like I mentioned, are you concerned about trying to protect your assets from divorced spouses or beneficiaries' future creditor? There is a high amount of divorces. Also, a lot of children get divorced as well. So, how to protect those assets? If your beneficiaries are different ages, are you concerned about timing of the distributions to them? Second marriage, big age difference of beneficiaries, any specific needs of the beneficiaries, and if you are a business owner, do you need succession planning for your business? You could transfer the business to your parents or sale of the business. Next page. So these are statistics in Canada based on 2018. This is the average estate size in Canada. As you can see, the median is between 50 to 250,000. But as you can see, the distribution is very rare to see estates over 1 million. But these are just some of the statistics that we see in Canada currently. Next page. So with the states, there are costs, there are legal and accounting fees. So these are based on Canadian statistics. The bigger the state, the more the fees will be due to the fact that it gets complicated. The average estate cost is around $12,500 on legal and accounting fees. And then if there are, let's say, issues with wills or more assets or through probate, these costs will definitely go up. Next page. So, with a will and an estate process, the most important person will be the executor. And the executor of an estate is an individual appointed to administer the last will of a deceased person and carry out the instructions to manage the affairs. So, pretty much, the executor will be the quarterback of the estate. He will work with lawyers and accountants to basically resolve the estate. And the main goal for the executor is to ensure all assets in the will are accounted for and that these assets be transferred to the correct beneficiaries. Also, with this task as an executor, you would have to pay off debts, pay out outstanding bills, sell and dispose unwanted assets. This could be real estate, cottages, cars, pay and file taxes, closing the estate, doing the legal work to close out the estate, notifying interested parties. This could be insurance companies, banks, beneficiaries, family members, and then filing with the courts. Like I mentioned, like the executor acts as the quarterback, and it is a very important role. And um, I think the process to determine who would be a great executor, the skills and qualities they should have is great organizational skills, attention to detail, some sort of financial acumen on how to pay bills and understand tax process, and some legal knowledge. Like I said, this is a very intensive process. On average, an executor will probably spend 400 to 500 hours dealing with the estate, and the average executive compensation would be around $18,000, and it would take around 16 months to complete this estate process. We are seeing the estate process go a little bit longer due to the fact that cottages and real estate are not selling as quickly, and it takes a little bit longer to close out the estate with assets within the estate. So we're seeing this time frame actually go up, and executive compensation go up as well. Next page. So I mentioned power of attorney before. Power of attorney is also important. And what I've seen in my practice is the executor be the power of attorney as well. And it's usually the more mature son or family member. It could be also a cousin or an aunt or uncle. But the power of attorney is a legal document that you sign to give one person or more than one person the authority to manage your money and property on your behalf. there's actually two types of power of attorney, one for physical assets and property and money, but there's also one for uh, medical care. So if you are, let's say, in a bad state or mental capacity is on the downward trajectory, this person would make medical decisions on your behalf. And sometimes it doesn't have to be the most, let's say, financial or legal literate person, but person that cares for you the most and wants the best for you. One thing that I do want to mention is that for power of attorney to be valid, you yourself would have to be in a mental capable place to sign the power of attorney. The courts will not treat the power of attorney if you are mentally incapable. One tip that I do give uh, retirees is that when you're in your later stages, let's say above 75, adding children to bank accounts as joint owners provides great benefits to pay bills and do financial transactions. So when you're older, sometimes you don't have the ability to go to the bank or do online banking. So if you have your, let's say, most trusted child joint on the account, they can fulfill these transactions. But also in the estate process, let's say if you do pass, this makes it easier to close down hydro bills, telephone bills, and deal with other services, and also to deal with your bank accounts as well. Next page. So what does a will do? A will basically identifies all your assets and distributes them to your beneficiaries based on your wishes. So with joint, we'll go on the right side of the table, non-probate property. So a house joint in your husband and wife's name, if one passes, that will go to another, will go to the other spouse. However, if both spouses pass away, that piece of property will go through probate. And with probate, anything over 50,000, there is a 1.5% probate fee that the government charges. Also, life insurance. Life insurance is a great way to pass down assets due to the fact that there is a beneficiary on the life insurance policy. It's tax efficient and it doesn't go through probate. Retirement accounts, tax-free savings accounts, RSPs, RIFs, locked-in retirement accounts, LIFs. They all provide a beneficiary. So that will not go to probate. It will go to the last remaining spouse. So it's a good way to manage the estate. POD designation is a very simple form of having multiple people joint on an account. If you do, let's say, buy a vacation property, it's always a good idea to buy it in multiple names, just so it's easier to carry those assets for further generations. And property in a trust. This is a great way to manage estates due to the fact that you still have control over your money, even if when you pass away. And it's a very tax efficient way to distribute assets for future generations. And things that go through probate are very simple. It's pretty much anything that if there's one individual owner and one name on the asset, that will go through probate. And in my experience, every client doesn't want to pay probate fees. So my goal as an investment advisor is to reduce how much money is going through probate with different strategies. Next page. So there's multiple strategies on how to distribute your wealth. This is just a very basic review on different strategies that you can implement. Like I mentioned, I think majority of the people are already retired. So they have employee pensions, government pensions, and also other registered accounts. So this is to implement these tax planning strategies, it's good to work with a financial advisor and also an accountant. So the goal is to implement tax efficient strategies of withdrawing from registered accounts. The government mandates on certain pensions, on RIFs and LIFs, a certain percentage each year based on age to be taken out of these accounts. Also, develop a tax strategy to maximize government pension distributions using pension splitting and Canadian pension plan splitting. So in Canada, you can split as much as 50% of your pension and also CPP benefits with your spouse. And this creates tremendous opportunities for tax efficiency. Transferring personal tax credits with spouse and also splitting capital losses with your spouse. If you do have losses in your non-registered portfolio, and let's say your other spouse has gains, you can offset those gains with losses to reduce your taxes. And then also you can share your tax credits with your spouse of, like, let's say retirement, old age credit, pension credits. You can split that with your spouse. And I work quite intensively with my clients to make sure that we are as tax efficient as possible. Also in Canada, charitable giving provides you a tax credit. It's a great way to reduce taxes and leave a legacy. Um, Gifting, I've recommended a lot of, I recommended the strategy to a lot of my clients, especially when they're in their late 70s. Gifting assets or cash. Gifting assets could be mutual funds, stocks, any type of asset, or cash to children or other hearers. Also, another strategy that I brought up is buying a home for the children or grandchildren. Um, that could be just providing a deposit due to the fact that the that entry level, the barrier entry to buy a house is quite high these days. And I find the younger generation doesn't have enough savings just to fund the down payment. So this would be a great way for your kids to start building a family. Like I mentioned before, life insurance, it's a great way to transfer wealth to a next generation. It's tax sheltered growth. Um, the the returns are quite stable. It is distributed tax free to beneficiaries after death, and is also estate friendly. Also, another idea that I give to my clients is creating an investment account in the children's or grandchildren's name with low income, due to OAS clawback. And if you have high income retirement, it's sometimes better to invest in, let's say, a child's name that is over 18 with low income, and that gives them the ability to increase their RSP contribution room, but also a great strategy for compound growth over the long time. Also, another idea that I provide to my clients is creating an RESP for their grandchildren. If you have access cash flow in retirement, a great idea would be to start an RESP. As the grandparents, you have the ability to contribute to their RESP, and also there would be benefits of government grants. So for every for every $2,000 that you contribute to your grandchild's education plan, you would get a credit for $500 from the government. And that would be tax deferred growth as well until they're 18 or ready to school. And you can withdraw that money in a very tax efficient way. Also, if there's any business owners, if you are thinking about, or if your kids are thinking about taking over the business, we call this an estate freeze. It's a great way to transfer future growth. You lock in the capital gains of your company on your private shares under your name, and then you let the other remain and you allow the remaining growth grow in your kid's name in a holding company. And this is a great solution for business owners trying to pass on their company to their kids. And like I did mention, trust, a great way to control money after death, and also a great way to distribute it as well. And we'll go further into trust in the next slide. Next slide, please. So in Canada, there are three main trusts. So very simple definition of a trust. Trust can be used to provide control and protections of assets, reduce probate fees at death, or serve as a will substitute, because within the trust, there is going to be a legal document on how the money is invested, how it is just distributed, and you can go highly in detail due to setting up a contract. And it's a great vehicle to transfer wealth to future generations. Like I mentioned, there are three trusts. The first and most popular is a living trust. So this trust is created when you're living, and this is known as an inter vivos trust. And this trust, you contribute assets to the trust while you're still alive, and set the terms for the management and eventual distribution of these assets when you pass away. When the original owner of the trust dies, the trust simply continues to follow a predefined instruction and does not participate in the probate process. And also, as a trust, it is treated as a separate legal entity, and it's taxed by itself, not as a total income of your income. Testamentary trust. is a trust is one that will create upon death after the assets pass through the normal probate process. Testamentary trusts are usually established by the will to care for a minor child or a disabled relative and often persist for some time. So if you have a minor child or someone with a disability and you feel that there might be some issues and you might die before they turn 18, this would be a great solution to provide money for the future. Testamentary spousal trust. A testamentary spousal trust is a specialized form of testimonial trust that can enable assets to transfer from the estate at their existing adjusted cost base. So pretty much in layman terms is what price you paid for it, bypassing deemed disposition and therefore deferring certain tax obligations. So this is strictly for spouses. And if your spouse passes away, you can transfer the original assets. It could be a rental home, a cottage or a rental property at the adjusted cost base to your spouse with not incurring a big tax bill and just prolonging the deferring taxes. Next page. So regarding retirement investment strategy, I've seen a lot of portfolios in my life, and I have a very simple rule on how I manage money is that the older you get, the less exposure you should have to equities. And what I see in the industry right now, and especially in Canada, a lot of retirees are taking on more risk than needed, especially in this high interest rate environment. So I ask the questions that I ask my clients is, what return is needed to meet my retirement goals? If it's 3 to 4% or 4 to 5%, I build the portfolio to meet those obligations. Another question I ask is how much money is needed to pay my bills and to preserve my lifestyle? So we look at all your investment accounts, savings, your pensions, and we create a plan to make sure that your lifestyle can preserve. We're taking a minimal amount of risk to meet your obligations and your lifestyle and to fulfill your retirement. And also, the more risk, the better the return, but also with more risk, there's possibility of bigger losses and issues. Just from a general portfolio management standpoint, asset allocation, what we call it, is pretty much the percentage of stocks, bonds, cash, alternative assets, and these are the biggest drivers of investment returns. And like I did mention in this slide, that retirees, people over 70, should have a lower portion to the stock market due to the fact that stocks are usually longer term investment vehicles and they do have volatility. And I mentioned in the slide that the government mandates you to take out money from a RIF or a LIF based on a percentage each year. So if let's say you're 70, you're required to take out 6% of these out of these investment accounts. So a loss of 20% in your investment portfolio will usually have a 20% decrease in your lifestyle based on cash flow needs. So the way I look at money when I build portfolios for retirees, my main goal is preservation of capital, income generation, and then third is capital growth. And then tax planning in retirement. Like I mentioned, you have to withdraw from these registered accounts. So the goal is to create strategies to minimize taxes and also take into consideration of OAS clawback. So in Canada, if you have income higher than 90,000, they will take 15% of your old age security. And if your income in retirement is over 148,000, they will claw back your whole old age security. And then with estate planning, create and update your will, designate beneficiaries for retirement accounts, maybe the consideration of a trust to minimize estate taxes. And what I do with my clients is I meet them on a quarterly basis, maybe through phone call, Teams, Zoom, to discuss their portfolio and to review their retirement plan to track progress towards goals, adjust investments as needed, and adapt changes in personal circumstances or economic conditions. Also, what I've been seeing in Canada is the lack of diversification. Most retirees, majority of their holdings are Canadian banks, and they're not diversified in other sectors or other areas of the world like the US, Europe, or even emerging markets, something like China or India. Next slide. So Regarding the estate process, and let's say if you do pass, I sent an estate organizer to Linda that will be provided to all the attendees in the chat room. So what documents would you need to fulfill your estate and then pass on these assets? So details of your funeral arrangements. I also recommend to my clients, I work with a funeral home to plan these arrangements because sometimes it's very stressful for kids to plan a funeral, to plan funerals. And the questions could be what kind of songs, what kind of speech, what kind of flowers would you like, costs. So these are great questions to have before death because, if you pass, you want your funeral arrangements on your wishes. Having copies of your will or wills, you can have more than one will depending on different assets. Having contact information of your power of attorneys and executors, having a copy of your insurance policies. Even if you do pass, the insurance company will not contact you or the executor to distribute the insurance policy. You will have to contact them yourself, or your executor will have to contact them. Employer information, depending on your age, it's good to have your employer information and first contact of your boss, just so that if anything does happen, you have the ability to access those work pensions and other medical benefits through the employer. A copy of your tax documents, bank account and investment statements, real estate deeds, trust documents if there is a trust, storage locker numbers, address, location of the safety deposit box, a key, or building a relationship with the branch manager and to make them notified that you are the power attorney or executor of the estate. So if anything does happen, you would have access to that safety deposit box. Loyalty programs. These are pretty much point systems on different credit cards or different loyalty programs through other retailers. This has been a very big issue in the last couple of years due to the fact that majority of people spend or purchase majority of their goods through a credit card, and some of these loyalty programs could be very attractive from a financial standpoint. Also, digital asset certificates. The creation of cryptocurrencies. A lot of money has been put into these markets, and it's good to have information and codes and passwords on some of these digital assets because if there is no account number or information, these digital assets pretty much become useless. Next page. So protecting your wealth, quick summary. I recommend to review your portfolio regularly. I would say maybe quarterly. Evaluate risk, your time horizon, and what your basic goals are. Ensure your estate is in order. Make sure your will is up to date. I recommend updating your will every 5 years if there is no actual material or life change. But if there is a life change, a new grandchild or second marriage or something, or if you change your wishes, it's great to update your will. Make sure your power of attorneys are up to date. If you are having some sort of medical condition, it would be a good idea to maybe reach out and find a medical power attorney that can help you. Make sure your beneficiaries are up to date and that you are confident in your executor to execute your will. Life insurance, make sure that if there is a need, life insurance is a good idea, especially if there's an outstanding mortgage on your house. This could cover your mortgage if you do pass away. A good idea during retirement is disability insurance. If you have a medical condition, if something happens, insurance is a great way to limit your risk through disability and critical illness insurance. I also tell my clients to establish an emergency fund just in case if anything happens, especially if medical bills, 3 to 6 months of your monthly expenses on average in a bank account or use a line of credit just for a protection fund because you never know what can happen. Develop a wealth management plan with an advisor. Make the most of your assets. I see a lot of money in bank accounts right now, not earning attractive interest. GICs are currently paying 4.5%. This might change after today, but there are some great opportunities currently. I know everybody's complaining about high interest rates, but high interest rates are very positive for people with savings. Protect your assets. If you're taking more risk than needed, sometimes take a look and see and ask yourself if the risk is really needed. Employ tax efficient strategies. Interest income is taxed at a high level in Canada, so there are alternative tax efficient investment strategies that can reduce your tax burden. And the main thing is ensure your loved ones will be taken care of. And if there is an opportunity for a trust, it's a good idea to look into. Next slide. So the role of investment advisor, I make this very simple. I basically act as a quarterback between internal and external partners. Like I did mention that we have tax specialists, estate specialists, but my goal is to manage your money, make sure everything is fine, but to work with your lawyer to your accountant to make sure that everything is fine and going smoothly. And my goal is to build a long-lasting relationship with you and make sure everything is fine. Next page. So very quick summary, my contact information is at the bottom. If you do have any questions, I know financial matters are personal. So, if you want to take this to another level and, give me a call or send me an email, I do provide portfolio evaluations, or if you have any general questions, feel free to reach out to me. Thank you very much.